Morningstar have released an article talking about the 20 US stocks to buy and hold forever, and in today's episode we're going to pick 6 of these and give you our own thoughts and analysis. We'll run through every single one of these, looking at their historical performances, also talking about the ratings, whether it's a strong buy or a hold. We're also going to take a look at their dividend safety, whether or not they will continue to be able to pay very nice dividend increases, and we'll run through the underlying metrics, looking at the likes of the free cash flow per share, their ROIC, their debt levels, and for each one of these companies, we are going to put them through our valuation model. We'll give you what we believe to be our intrinsic value. We'll tell you what we see as our acceptable buy price. Now, this will incorporate an investor margin of safety, and we'll also look towards Wall Street to see what they see in terms of upside over the next 12 months. Now, the first one we're looking at, it is Waste Management, ticker symbol WM. We do have a double buy rating from Seeking Alpha and Wall Street with a hold from Quant. Now, we do notice it is trading at its 52-week highs. It has a forward yield of 1.44% and a forward PE of 28.6. Bear in mind, S&P is around 22.5, but as always, for relevancy, we will compare it to the sector. In terms of over the last 12 months, it is up 28%, and if you've been holding this for the longer term, well, you would be up 374%. Bear in mind, if you reinvest dividends, you would be up marginally higher. Now, in terms of their dividend safety, 70 source, so it does look to be safe. Market cap 84 billion. It is a large cap company, and we can see just this month it was reaffirmed that safe score, therefore indicating a dividend cut does look to be unlikely. Now, in terms of the last recession, well, in fact, they did increase the dividend during the 07-09 Great Recession. They had negative 12% recession sales, pretty much the average of the S&P during this period, but they did outperform negative 40%, S&P itself coming in at negative 55%. Now, in terms of dividend growth, well, we do quite like to see nice high single digit, 7.1 in December last year, high single digit over the last 5 years, and over the last 20 years, they have been increasing those dividends very rapidly, 33% on average. Now, they have been paying a dividend for 20 years with consecutive increases, therefore meaning they are 5 years away from becoming a dividend aristocrat. Now, we always like to look at dividend yield theory on this channel. It does state as well a company is undervalued when the current yield sits above the 5-year average. So for WM, we do have our first overvaluation signal. And on the forward P, we can see it marginally higher than the 5-year rolling of 27.2. It does also sit significantly higher than industrials of 19.2. Now, in terms of the payout ratio, on this channel, we do draw your attention to the free cash flow payout. Earnings is susceptible to manipulation by management through accounting, and below 60% is what we do target. Pretty much every single year, it has been there or thereabouts below that 60 level. 2024 anticipated around 58, so no real margins of worry for this company. In terms of the free cash flow, what we want to see here then is increasing consistently over the longer term. We do get some inconsistency, but it has been increasing over the last 10 years. And again, that upward trend is anticipated to continue into 2024 and beyond. Now, when we take a look at the sales growth, 3 to 7% is what we want to see over the longer term. On average, you could argue they probably have hit that, although we do note 2 of the last 10 years have had negative growth. And over the longer term, we can see they have pretty much increased their top line around 45%. In terms of shares outstanding, well, we want companies that do share buybacks returning excess cash, and we can see that for Waste Management, they have bought back over 10%, in fact around 60 million shares over the last 10 years. We then move on to the ROIC, one of our favorite metrics. 10% or more, give us faith management are able to effectively allocate their capital, and we do get to see exactly that. Double digit every single year. In terms of the margins then, on the operating side, above 12%. In fact, we get a sense here of operational efficiency, 14% in 2014, 19% in 2023, so it has been increasing. And the free cash flow margin consistently above that 5% minimum level we do want to see. Net debt to EBITDA, very important metric. Earnings before interest, tax, depreciation, amortization. Correlates to dividend safety, balance sheet strength, and below 3 is what we do want to see for the majority of companies. Now, as a reminder, these numbers below do show the number of years it would take the company to pay off all of their debt net of cash on hand, and it has been, bar 2020, below that level and has been decreasing since that 2020 high, 2.33 anticipated in 2024. So it does look good, off to a good start with Waste Management, a lot of high quality metrics that we do like to see. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And typically on the channel, we do run through every single one of these models. Today's episode, though, we are going to jump straight into that intrinsic final calculation, which is the average of these three models, coming to $204. Now, with the current price sitting at $212, what this essentially tells us is that Waste Management, from our estimates and judgments, is trading at a premium right now. Typically, what we do like to do is start off with a 10% margin of safety, which we execute on companies if it meets our three golden criteria: a wide moat, strong financial metrics, good forward-looking data. And if you believe that for Waste Management, well, it would be a buy around $183. So as we said, right now it is trading above our intrinsic value at a premium. In terms of Wall Street and their expectation, well, they believe the share price will go higher. They do see upside of 8% over the next year. And as always, in these episodes, do give us your thoughts below, whether you are buying or maybe they are now on your watch list. Before we move on to the next stock, just to let you know, we have released our latest free weekly article where we look at 10 undervalued stocks with excellent balance sheets, completely free, instant access. If you do want to take a look, sign up by clicking on the pinned comment below. And as you can see, you will also get access to all of these other articles and more. The next one to buy and hold forever from Morningstar is Moody's Corporation. Now, over the last 12 months, it is up 27%. And if you've been a long-term shareholder, you would be up 387%. Similar to that company, Waste Management, that we just reviewed. Over the last 10 years, both of these companies have outperformed the S&P, and we can see sitting at a 52-week high right now with a double buy rating and a hold from Quant. It does have a yield, although fairly small, at 0.81% forward looking, and in terms of a forward P, it does sit fairly high at 39, but as always, we do need to put it into perspective and compare it to the sector PE. So in terms of dividend safety then, so let's move on. 83, it does look to be very safe. Market cap, 77 billion. It is a large cap company. Again, it was just reaffirmed not too long ago, this dividend safety score. Dividend cut looking highly unlikely. Last recession, then, they maintained the dividend. It wasn't one that increased it. It didn't also cut it. Below average growth, and they also trailed the S&P. We love to see this. Double-digit growth this year. Double-digit over the last 5 as well as the last 20 years. And we can see as well they have been increasing those dividends for the last 14 and paying a dividend without a reduction for the last 23. Now, when we take a look at dividend yield theory, you could argue reasonable valuation as the yield isn't too far off the 5-year average, although we do note the forward P just under 40, sitting significantly higher than the rolling 31.4 and significantly higher than the sector of financials 11.1, but you could argue there are a lot of companies in here that don't have the growth, the profitability and other quality metrics that Moody's Corporation does. In terms of the free cash flow payout, well, below 60% every single year, 30 in the more recent year, 31 anticipated next year, so no real surprises. We would be expecting a double-digit increase again. In terms of the free cash flow, more than doubled over the last 10 years, and we do expect this to increase into 2024, but we can see here there is a little bit of inconsistency over the period. We then move on to the sales growth, very strong, 3 to 7% at a minimum every year. We do see a drop into 2022, but it has rebounded strongly into 23, and we can see on a trailing 12-month basis, 15%. We then move on to the numericals, and we can see nearly doubled over the longer term. And when we draw your attention to those shares outstanding, we can see 215 down to 184. But they do share buybacks, but very minimal and fairly trivial over the period. ROIC, well, strong double digit. We will point out it has been decreasing over the longer term, but even over the last 2 years, and 21% on a trailing 12-month basis does still make it very attractive to potential investors. In terms of the operating margin, well, this isn't something we particularly like to see. I mean, the negative here is operational deficiency. The margins have dropped. The positive to note, though, it is still significantly above that 12% level. And when we do look at the free cash flow margin, very strong free cash flow machine for sure, 32% in 2023. We then finally bring your attention to the net debt to EBITDA, 2.01 in 2023, 1.6 expected over the next 12 months. So clear to see that dividend safety score sitting at very safe. And we can also note the balance sheet does look very strong. In terms of the valuation then, so getting straight to it, and as always you can grab a copy of this model by clicking on that pinned comment below, running your own numbers through whether it's for Moody's Corporation in your portfolio or those on your watch list. So what this signals to us then, an intrinsic value of $423, it is pretty much right there at the current price, so it is trading around what we expect it to be. In terms of margin of safety though, for those who are looking at a 10% who are looking to add this onto the watch list, you would have to wait for around $381. In terms of Wall Street and their forecast, well, over the next 12 months, they don't see any gain with Moody's Corporation. In fact, upside, they have -3, which is effectively downside. Their price target, $415. We then move on to CX Corporation, a railroad company which isn't at its 52-week high unlike the previous two. We have a double buy rating with a hold from Quant towards the mid to lower end of the 52-week range, a high yield at 1.44% and a lower PE 17.23. Over the last year, barely any movement to the share price. Over the last 10 years, up 228%. Again, another one that has outperformed the S&P. Another very safe dividend score at 85, market cap 65 billion, so it is a large cap company. And we can see again, very safe dividend cut looking highly unlikely. In terms of the last recession, well, they increased the dividend. They did have below average growth, but we do note here that it was a near S&P return at -51. And we also like their dividend increases, high single digit this February, high single digit on average over the last 5 years, 16% on average over the last 20, and we can see 19 years of consecutive increases. Now, in terms of dividend yield theory, we can see now an undervaluation signal. The yield sits higher than the 5-year rolling, and the forward PE, although marginally, does sit below that 5-year 17.7. When we do take a look at the industrials as well, it does sit high at 19.2, thereby essentially telling us we have a triple undervaluation signal, but do keep in mind we don't look at any of these models in isolation. Free cash flow, well, consistently below 60%, no surprises in how they are able to offer nice dividend increases, 30% anticipated over the next 12 months. Free cash flow also looking very strong. It has increased, but again, very inconsistent, and we are anticipating a small drop over the next 12 months. In terms of sales growth, well, right now you can clearly see the cyclicality of this company. 5 of the last 10 years, they have had negative growth, and when we do look at it numerically, there hasn't been massive movement to the top line over the last 10 years. What they have done though, very, very rapidly, in fact, they have bought back around 1/3 of those shares outstanding from 2014 at 3.01 billion, now down to 1.99. So a very positive sell point of this company when you are looking at your own investment thesis. We then move on to the ROIC, strong double digit across the board, 14% in the more recent year. And when we do come to the margins, very, very high. It has been increasing as well over the longer term, 38%. And the free cash flow margin is something you do love to see with companies in the mid-20s over the last 6 years. Finally, we get to the net debt to EBITDA. A lot of consistency here, significantly below 3 year on year, 2.44 in 23, 2.32 over the next 12 months. So again, another clear indication of that dividend safety. We then move on to the valuation, and for CSX today, we are getting an intrinsic value of $43. And when we take a look at the current price, we do see it is much, much lower. So a 10% margin of safety, a buy up to $39. Then we keep going till it is near that current trading price. And in today's episode, we can see at least a 20% MOS level, not there at that 25 just yet. In terms of Wall Street and their forecast, well, over the next 12 months, they also see the share price going higher, 16% with a price target just under $40. We then bring you to the Coca-Cola company, a triple buy rating, a strong buy from Quant, trading towards its 52-week highs with a yield of over 3%, a forward P pretty much in line with the S&P, and over the last year, pretty poor performance, just up over 3%. Over the last 10 years as well, up around 51, an underperformer in comparison to the S&P. We have a dividend safety score of 80. It does look to be safe. Market cap 270 billion, a mega cap company, and it was reaffirmed that dividend cut does look to be unlikely. Now, last recession, they did in fact increase the dividend. They had above average growth, and they did significantly outperform the S&P with their -31 growth. Now, with their increase, it was nice this year. Over the last 5 years, disappointing, as we do want to see at least an inflationary increase of around that 4% level. And over the last 20, nice high single digit at 7%. They are also a dividend king, not only 61 years of consecutive increases, that they've been paying a dividend for the last 104 years without a reduction. Now, in terms of dividend yield theory, we get a reasonable valuation indicator on the yield. On the forward P, we do note it is lower at 22, and when we compare it to consumer staples, it does sit higher at 22.3 versus 18. We then draw your attention to the free cash flow payout, which we bring up for consumer staples to 70%, pretty much above that nearly every single year, so it is consistently around that 80% for the last 5 years. 2024 expects to be there or thereabouts, so with this company you probably will get quite a lot of consistency, just not a lot of rapid growth to that dividend. In terms of the free cash flow per share, well, again, increasing over the longer term, but this isn't a tech company, don't expect massive growth over the long period as well. In terms of sales growth, well, we can clearly see not the best over the last 10 years, with 6 of those years being negative growth, and we can clearly see when looking at their sales, it went from a high of 46 billion in 2014 down to the lows of 2020 of 33 billion before picking up to 46 in 2023. In terms of shares outstanding, don't expect too much as well from this aspect, 4.45 to 4.33 in the more recent period. ROIC, though, very consistent, increasing marginally as well, up to 18% in the more recent year of 2023. And the margins also look good. Operating efficiency, 24% to 29%, and free cash flow margin consistently above the 7% in the 20s just over the last 5 years. Then we get to the net debt to EBITDA, a very strong balance sheet. Below 4, so we lift that up for consumer staples from 3 to 4, 2.08 in 23, 1.7 expected over the next 12 months. So again, a very strong balance sheet, and that dividend does look to be secure. When we then take a look at that intrinsic value at $68, what we can see with a current price of 63, it doesn't yet warrant a 10% margin of safety. Right now, if you are looking at it, you will only be getting a 5% based on our estimates and judgments. In terms of Wall Street, though, what they see over the next 12 months, pretty much around the same value as our intrinsic value. They only see around 8% upside. And as always, let us know your thoughts in the comments below. We then move on to a very high quality company. It is automatic data processing ADP. One buy rating with quant, a double hold from the other two, trading towards its 52-week highs with a yield of 2.26%, a forward P of 27, and over the last year it is up around 13%. Over the last 10, up 250, and again, another one that has outperformed the S&P 500. Dividend safety, very safe score of 97. Market cap, 101 billion, a mega cap company, and reaffirmed last month, dividend cut looking highly unlikely. Now, in terms of the key metrics, while they increased the dividend, they had negative sales but still above the average, and they significantly outperformed the S&P. Dividend growth, well, double digit just last year, double digit over the last 5 years, double digit over the last 20 years. So what more do you want? What a very strong company. And we can see 1 year away from becoming a dividend king. In terms of dividend yield theory, well, we do get an undervaluation signal on both the yield as well as the forward PE. But when we do compare it to industrials, it does sit much higher than the 19.2 sector PE comparison. In terms of the free cash flow payout, whilst we want below 60%, it has been pretty much straddling around that over the longer term, anticipated though to drop down to 42 over the next 12 months. Free cash flow as well more than doubled over the last 10 years and expected over the next 12 months to increase rapidly to $13.40 per share. In terms of sales growth, well, nice to note it has been at a minimum our 3 to 7% level, just 9% in the more recent year as well, which is always great to see. Now, they've increased their top line over the last 10 years by 80%, and on top of that, they've returned some nice excess cash through those share buybacks, although we can see very minimal but very consistent. We then get to the ROIC, now very strong, one of the best we have come across on this channel, and very consistent, and has increased over the longer term. 64% in 23, again making it incredibly attractive for potential investors. And this is what we want to see from any company. We want increasing revenues, increasing margins. That is exactly what we get with ADP, and their free cash flow margins are very consistently strong. We then move on to the net debt to EBITDA, pretty much one of the best companies that you will come across in terms of metrics. Below 3 is what you get, and in fact 0.28 in 23, 0.02 expected over the next 12 months, so you can't really get much better than automatic data processing. In terms of the valuation, and don't forget you can grab a copy of this model by clicking on the pinned comment below, $281 with the current price at $250. That 10% margin of safety indicating a buy pretty much at that current trading price, but as always it will come down to what level you see fit as an investor. For those seeking 15%, you would have to wait for around $239. So as we can see, 10% MOS in today's episode. And Wall Street, well, $262 with 5% upside. They don't have it as high as our intrinsic value for ADP. We then move on to Altria Group, where we do have a buy rating from Seeking Alpha with a double hold from the other two. It is trading towards its 52-week high with a forward yield of 8.57% and a forward P of just under 9. We can see it is up around 6% over the last 12 months. Over the last 10 years, you would be up around 11%, but it has come quite some way from the highs that we see around $77 in June 2017. We're talking about 7 years ago. In terms of dividend safety, well, 55 borderline safe, market cap 79 billion, a large cap company, was reaffirmed. So what this means, that a borderline safe score, meaning a moderate risk of a dividend cut over a full economic cycle for Altria Group. And the key metrics, well, they increased the dividend during the last recession, below average growth, but they did significantly outperform the S&P with their negative 20% return. Now, what I quite like, last summer they increased it in line with inflation, which is always great for a high-yielding company, 5% over the last 5 years, but low single-digit over the last 20. We also note they are a dividend king, 54 years of consecutive increases, and when we do come to dividend yield theory, we do get an undervaluation on the yield, as well as the forward P, although it is marginally lower than the 9.3, but it is significantly lower than consumer staples as a whole at 18. We then move on to the free cash flow payout. For tobacco companies, below 85%, 63 in 23, expected to increase to 87 over the next 12 months. So with this company, just have realistic expectations that dividend, whilst it will grow, it wouldn't be much more than that 3 to 4% level. Free cash flow, great to see it has nearly tripled over the last 10 years. But again, the inconsistency is showing with a drop anticipated over the next 12 months. Again, sales growth very minimal as we can see, not even 3 to 7% over the longer term. With the last 2 years, we do see negative drops to the top line, but on a trailing 12-month basis, 11% is a good sign that 24 can hopefully be a strong year. So there we have the numericals of the total sales. Always factor in inflation, because if it's not increasing at least 3 to 4%, in real terms it is reducing. And what they also do is share buybacks again, as we can clearly see. We then move on to the ROIC. Above 15% for tobacco companies. That is what you get with Altria. Very strong, in fact, over the last 2 years, and 53% on a trailing 12-month basis. And when we look at the margins, I love to see this. Increasing margins, a lot of efficiency over the longer term. And on the free cash flow margins, well, very, very strong. These are some very large numbers on both the operating side as well as the free cash flow margin side. We then move on to the net debt to EBITDA, 1.79 in 23, 1.7 over the next 12 months. In my opinion, this does look like their dividend is safe. No red flag indicators so far. As always though, don't forget, if you are enjoying the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Intrinsic value then at $49 with a margin of safety at 10%. We can see it isn't a buy, as it has to be around 44, 48. With 5%, we can see pretty much that level it is trading at right now. In terms of Wall Street and their expectations, well, they see no upside. They pretty much see it trading at the price they see it over the next 12 months. So this upside does show 0%. As always, let us know your thoughts in the comments below, whether you believe any of these are buy and hold forever. Maybe you hold some of them yourself, or maybe these are on your watch list, or in fact you may not want to hold any of these. Let us know your reasons below. And as always, if you enjoyed the episode, smash that like button, and we'll see you all on the next one.